Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
Political prediction markets allow traders to profit from future events tied to public decision-making. But as oversight systems come under strain, POGO says that structure creates risks current ethics laws were not designed to address. Janice Luong, a policy analyst at the Project on Government Oversight, walks us through how those markets work and where the guardrails fall short. Janice, welcome back to the show. It's great to have you.
Thank you. It's great to be here.
Let's talk about prediction markets. You've got some new analysis out that looks at the growth of prediction markets, especially those tied to political and national security events. What has POGO been looking at that really made you say this is now an urgent oversight concern?
So POGO is no stranger to addressing congressional insider trading. We have a long history of addressing this issue. So when we first heard about the suspicious trades on these prediction markets, specifically referring to the contract that wagered the ousting of Venezuela's president, Nicolas Maduro, that was pretty much our first signal to track this issue. Now, we recently found out that a U.S. soldier was recently charged for betting about $30,000 on Polymarket and allegedly securing a profit of approximately $409,000 from it. So we're tracking this development as the case develops, but we are also tracking other developments, and there has been many, such as campaign staffers recently telling NPR that they profited off betting their own candidates using their own polling data. And some have also admitted that it was common to bet and profit using insider information. Now, I think the developments on prediction markets have been rapidly growing, and honestly, I have not heard of such a stark example of people coming out and admitting that there is insider trading happening. So this is definitely on our radar, and POGO is tracking multiple developments at the moment.
For people who might be less familiar, walk us through how these markets operate, particularly how event contracts on platforms like Polymarket or Kalshi are structured, but also how they're supposed to be regulated.
Sure. So on the top line, prediction markets are online platforms where a participant can sell or buy contracts called event contracts. And typically these event contracts have binary outcomes where you get to wager on future events. So on these platforms, the contract would present a question, a yes or no question. For example, one that is active at the moment: will Congress pass the SAVE Act? And you can bet either yes or no, and then you get a payout when you correctly bet on the outcome. And the price of these contracts typically are valued between a cent and $1, with the value of the contract reflecting the probability of the event occurring. And to your question of what is the right way to regulate these markets, that's the $1 million question we are trying to resolve, right? But right now we are seeing an enforcement problem. So right now there are rules that exist. It looks good on paper, but rules can look great, but when there's no enforcement, it's pretty much deemed ineffective. Now, right now, how regulatory enforcement looks like is that Congress has deferred authority to the CFTC to oversee these prediction markets. And then the commission sometimes review these contracts sporadically in limited circumstances. But the CFTC also relies on these prediction platforms to oversee whether they're complying with regulations or not. So really, the first line of defense in terms of regulatory compliance are from these platforms. And this is where the self-policing comes in. And right now, we are clearly seeing this process fall through the cracks because we are seeing event contracts that are clearly prohibited under current regulations being on these prediction markets. Now, and to be clear, there is a clear ban on event contracts that relate to or refer to terrorism, war, assassination, unlawful activity, and those that are contrary to the public interest. As we can see, there are contracts that are related to war that are actively being traded. So clearly, something is amiss, and that is where I think Congress and the CFTC can come in.
Janice Luong is a policy analyst at the Project on Government Oversight. Janice, as you're describing this really complex environment, it strikes me that we might have just a very basic definitional problem, right? Is this betting? Is it information sharing? Is it hedging like you would in a commodities market where you think the price is going to go up, so you buy contracts that hedge that? What is this really? The founders of these markets say that they're just information sharing, public square sorts of things.
So describing these prediction markets as betting contributes to the larger discourse, right? Because when you refer these prediction markets to betting, then we are going into the gambling territory of things, which is currently being litigated. Now, I would assert that when you are participating on these prediction markets, you are betting on something. You are betting on the event contracts you are actually betting on an event that will actually occur or not occur. Now, the assertion that these prediction markets is information sharing, technically not wrong. Someone can just bet on an event contract based on what someone else told them, and technically true. However, the problem is that information sharing occurring within the government and to people who are privy to non-public information. That is really the crux of the issue, is that it is really hard to determine, it's really hard to prove insider trading in the government. And so when it is occurring within the federal government or with public officials, it's difficult to hold them accountable. And that is really the issue here. As for hedging, it's really a big question mark, the economic functions of these markets, because as we see in certain trades, one can argue that highly profitable event contracts are being placed without hedges. For example, traders have betted $500 million on the price of crude oil only 15 minutes before U.S. President Donald Trump announced a 5-day delay to attack Iran's energy infrastructure, and that sent the market plunging. These represent participants placing large bets without a hedge. Another more practical example is, say, like, if there is an event contract, you can bet on anything. So if there's an event contract that bets on like, oh, what color Gatorade will this athlete be dumped with? Now, it's hard to argue that there is an economic function in participating in these kinds of event contracts. And what is the real hedge here? So that also contributes to the conversation of why these trades are raising concerns, because when you start seeing traders betting large amounts of money without hedging something, it almost gives the impression that they're almost certain that their bet is the correct one.
Janice, we already have conflict of interest and ethics laws for federal officials that don't seem to be applicable here, or at least enforceable, as you mentioned. POGO recommends several actions that Congress could take now to prevent corruption. What's on your list?
Sure. So that is correct that there are existing laws in place that basically make insider trading illegal. Government officials are prohibited from participating in any matter in which they have a personal direct or indirect financial interest. However, it's not comprehensive. Under Title 18, there are certain conflict of interest statutes that do not apply to the president and vice president. And this is a weakness in the law, because what prediction markets reform demands is a prohibition across all three branches. So this is the gap that Congress can seek to fill. Some solutions that Congress can take is to ban federal officials across all three branches and government employees from trading on these prediction markets. Now, recently, the Senate has passed a resolution that basically bans the Senate from trading on these prediction markets. However, it is a Senate rule, and that means it doesn't apply to anyone beyond the Senate. The House recently introduced a resolution that mirrors the same prohibition as the Senate. This is a great first step for both chambers. However, we need comprehensive laws that clearly address this issues, because opacity is the enemy to oversight and accountability. So solutions that Congress can take are to codify the prohibition of federal officials across all three branches and government employees from trading on these prediction markets during their tenure, as well as prohibit dependents and spouses of covered individuals from engaging in any financial transaction through prediction markets for the duration that the covered individuals are employed within the government. The Congress can also pass clear statutes that direct the CFTC on what event contracts are prohibited and what isn't. Currently, the Commodity Exchange Act gives discretionary authority to the CFTC to review what event contracts fall under the prohibited categories. However, it would be clear for Congress to pass a clear prohibition provision that states that event contracts related to or refer to war, assassination, terrorism, illegal activity, and those contrary to the public interest as the event contracts that are prohibited. They should also expand the contract prohibition to death, government and military actions, and electoral outcomes, especially during a midterm year. I expect there to be a lot of activities on these prediction market platforms. And the concern here is really that these prediction markets create a financial incentive that would eventually shape how lawmakers make decisions in Congress. And it really shouldn't be that way. Congress should prioritize the well-being of the public rather than seeking to gain a profit from these prediction markets. And one last important thing is to implement meaningful penalties, such as disgorgement clause, significant fines, and removal from office. And currently there are certain legislation that has been introduced that addresses this.
Janice Luong is a policy analyst at the Project on Government Oversight. Janice, thanks for walking us through this.
Thank you very much.
We'll post this interview along with a link to the POGO paper at federalnewsnetwork.com/Federal Drive. Hear the Federal Drive on demand. Subscribe wherever you get your podcasts.